Coming to you with another video where I talk about things. And in this video, talking about Bitcoin, Ethereum, and altcoins. And are they ready to roll? In other words, are they ready for a big maneuver in the market? Will it be Bitcoin leading the way, or Ethereum, or maybe some other altcoin like Solana or something else, Cardano, Ripple, Litecoin? Will we see a sudden alt season happen, what they call an alt season, which is just extended buy pressure for altcoins and meme coins, AI coins, all these kind of things? Are we going to see a sudden big maneuver to the upside for those coins before the end of this year? We got about a little bit, about 2.5 months left, because the last week of the year typically very little happen. I mean, you do have years where random things do happen nicely to the upside, but very often the last week of the year can be either chill or pretty big, right? I mean, not a pattern to trade, obviously, but just observing what has happened. But yeah, a little less than 3 months, just slightly more than 2.5 months. Right, about 2 3/4 months left. 3 3/4 months, right, left in the year. About 2.5 months until Thanksgiving, Black Friday, and all that. And a lot of people sit around the Thanksgiving table and find funny ways to discuss things with their family, and inevitably Bitcoin will come up, and then sometimes some alts will come up in conversation. And if you're into this space, you will typically be the one defending your argument. By the way, even when times are good, people are always like, oh yeah, when Bitcoin's up, everyone thinks you're a genius. No, they also don't think you're a genius even when times are good, right? Even if you're up 10,000%, they don't think you're smart for being in the space. Most people, yeah, some do, obviously. And those that do, usually the ones who are either already in the space themselves or thinking about it, right? Getting close to it, approximating being in the space. Right? But the people who actually, like normies usually despise this space, whether it's doing well or not. And by the way, they will continue despising it until they are programmed not to, which means they are going to consume the information that tells them to hate crypto until they are no longer told to hate it. You're going to be told, oh, stablecoins are good for your dollars, so use crypto stablecoins because you can convert your paycheck into stablecoins and pay a fee for no reason to do so, because you could just keep your dollars as dollars if you're not going to be entering the crypto space. But yeah, go ahead and use crypto stable dollars when you get paid, and you can get your faster, for people taking payday loans, which is a horrible thing. For people taking, cashing out whatever they can in crypto, just because they need to or something. It's going to provide all kinds of solutions, yeah. But a lot of them will be solutions people don't need, and they don't realize they don't need them. And I'm saying that as a person who thinks that crypto is a wonderful solution to many things. I'm not against it at all, right? In that sense, it does provide levers for financial freedom if you know what you're actually doing. When people hear the words financial freedom, they imagine being rich on a tropical island with nothing to do and all the money that they need to live their life. That's not the definition of financial freedom. Okay? Financial freedom is not being limited in your transactions. Yeah, you might be limited in terms of the number you can send, because you might not have more numbers to send, but that isn't financial freedom. Financial freedom is the ability to send or receive a transaction without middlemen or other restrictions impeding it in any way whatsoever. That's financial freedom. Okay, maybe you don't have $1 million to send to somebody. If you only have $500 to send somebody, or $20, whatever, The fact that you can send and or receive said monies without an impediment from an outside force, like a middleman, a bank, a broker, an agency, a custodian, anybody, a clearinghouse, right? The fact that you can do that, you can send the transaction directly to the recipient, that right there is the freedom that crypto gives you when it comes to financial freedom. That's it. That's the financial freedom. Okay? Now, there's other things about it that feel like financial freedom, but they're actually other values. Right? It's mobile, it's portable, right? Mobile, cross borders with it. You can have infinite monies with you in your little hardware wallet or software wallet if you're crazy enough to store a lot of money in a software wallet. I would not do that. You could have it infinite amounts of money stored in your brain if you're smart enough to remember your secret phrase. I honestly would not keep everything in the brain wallet because if for some reason, who knows, maybe you get hit in the head one day and you forget your password. I mean, shit happens, right? Do you really want to trust the wet noodle in between your ears to remember all of those passwords? It might be a little risky, especially if you're dealing in millions or billions of dollars. Right? You might want to have something a little more reliable than a wet safe, right? Or a brain safe, or brain wallet, wet wallet, whatever you want to call it. Like, yeah, for small transactions and stuff, maybe you have one wallet that you remember. If you're good at that thing, look at this cute dog. Wow, hello. Hey, buddy. Hello. Whoa, he's so cute. Oh my God, you're so cute. Wow. Hello, buddy. Whoa. Oh, you're so good boy. Oh, he's a good boy. That's Karima. Bello? You're so bello. He is bello. Good day. Wow. Very happy dog. Yes, I miss my dog. And I will forever miss my dog. Hello there. I said hi. Yes, you said hi. Hi, Yvonne. Nice to see you. So is the market ready to roll? Right? Are the altcoins going to move first? Is Bitcoin going to move first? And by the way, which direction are they going to go? Right? Because we are moot on direction. Right? It is totally moot. Like we, as VEPS traders, do not care which direction the assets move. Like it is completely moot. What matters when you're actually trading? What matters is that you're in the trade in the way that it is going, and that you get out. You take your profits early and often. And you don't stay in. So you don't try to swing trade volatile assets. It's just there's nothing good gonna come of that usually. Maybe you'll win one once in a while, but 9 times out of 10, you're gonna get hurt, either because you're gonna lose money, or time, or both. Right? Like it may suck to take a percentage loss on a trade, or 5%, God forbid, like 10% or more. Right? But if you don't rip that band-aid off, you might be in that position for many days. It might get worse. It might end very badly. You might get wrecked, right? And then you've lost all that time when, yeah, you lost 10% on that one trade, but you could have made it back within hours if you were trading fast and furious. You don't have to be in every trade, yeah, but you could have made back to 10% over a period of another day or two or three, instead of being in a losing trade, just sitting there losing all day long for days at a time. Right? It's not worth it. It's just not worth it. Right? It's worth ripping the band-aid off, saying ouch for a second, understanding that you controlled that loss, which is better than being in an uncontrolled loss. Ultimately, the power was still in your hands, and you still had enough capital to put on the next trade, instead of getting wrecked and having to deposit more, once again, to your trading account, to lose it yet again in another poor trade. Right? So do that. Right? Always do that. Be the trader that is not afraid to lose a trade. Like, you can't be afraid to lose a trade. Right? You know, look, it's better to lose 20 trades out of 100 that are all minimal in size, like not more than 1% loss, and to win the other 80 trades out of 100 that are on average, you know, anywhere from whatever, a 0.5% to 2% in gains, right? Depending on how you're trading and everything else, maybe less, right? But if you're if you're able to win consistently the vast overwhelming majority of your trades and keep your losses to a tight minimum, and again, the 1% loss, that's just what I recommend is like your maximum. If they don't lose even that, oh, somebody brought their horse out here and they dookied everywhere. Interesting. Okay. Interesting place to bring your horse to dookie when there's clearly better places for that, not even 4 feet away on the actual earth instead of on the nice path that they've made, or well, whatever. People's is people's. What are you going to do? I say, is going to make a difference. So at this point, the market is going to do what? Think about it. The market is going to do what? The market is going to continue to move with the VEPs. That's what it always does. Why does it do that? Because that's how the markets move. It's the volatility and the entropy that create the movement in the market. It's nothing else. Right? It's really that simple. And I know you want to make it complicated. No, it's this pattern. It's this EMA. It's this channel. It's none of those things. It's none of those things at all. It just isn't. You can look for reasoning all you want. You can look to find something that tells you, that confirms your bias. And you could do that all day, and you could find hidden things that will quote unquote confirm your bias. But they're not actually confirming your bias. They're giving you illusions of bias confirmation, right? They're not actually confirming your bias. They're really not. They are just telling you things that appear like, oh, this confirms my bias. Because the information you're using, if you're using traditional technical analysis tools of any kind, I don't care if they're subjectively drawn lines like EMAs or random price lagging tools like EMAs, or like you could be using Fibonacci's or randomly, subjectively putting on a chart. You could be using EMAs, SMAs, whatever, any kind of like silly, quote unquote, math based tool, but that's just really lagging information. Lagging information is still just lagging information. There's no two ways around that. You're not going to suddenly find that your lagging information that was crap yesterday is suddenly going to be good lagging information today. That's just not a thing, right? Lagging is lagging. Doesn't matter what day of the week it is. It really doesn't matter. Right? What matters is the information leading. Because if it's not leading, guess what? It's not going to tell you what is likely to happen. Why not? Well, because that's exactly what leading information does. Right? Leading information tells you what is actually likely to happen. It doesn't tell you about what happened. It's not concerned about what happened. What happened is totally moot. And when I say it's totally moot, I mean it is completely and totally moot. We don't care about what happened in terms of where the, like just reading the math of the numbers and say, oh, the price went down. Yeah, genius. I can see the price went down. I don't need in fact, I don't even need the price candles to tell me the price went down. I can look at the volatility and the correlation and tell you that the price went down. Right? I can look at the entropy and the correlation and tell you the price went down. I can look at the variance and its correlation and tell you the price went down, right? Or up, or whatever side, whichever way it went. right? Why? Because those are accurate leading information, and once they're recorded in place as having taken place already, well, that's telling me very clearly what happened. And yeah, occasionally, very rarely, price will be out of step with something like the returns, but very rarely, because typically price just follows the returns. Yes, you have occasional, because there's randomness in the market, so occasionally there will be events where on a particular time frame the price action might go up, even though the indicator of the returns is saying actually it's headed to the downside. And so you have a little bit of a discrepancy there for like a candle or two, maybe three. Wow, real sick outlier. And then what will happen? Price will follow the returns again. And most of the time, like the overwhelming majority of the time, that's what price action does, right? Price action just follows the returns. It does not just randomly ignore the returns. No, price action follows the returns. Why? Because the returns.
I can't answer this question. Please provide more context for a complete question.
Price action follows the returns because what creates the returns? The standard deviation of returns. Right? That's what creates the returns, is the standard deviation of returns. And what does the standard deviation, what happens when the standard deviation of returns creates the ask and bid price, right, are moving, right? And as they move, what happens? The price action moves. It follows the standard deviation of returns. It follows the returns, right? As the asset moves along through the standard deviation of returns and correlation, so the returns create essentially a pathway. Okay, and think about it like neurons or a brain. The returns create like a pathway for the price to be able to move through. Without that pathway, the price can't really move through that area, right? Now, again, randomness can happen and does happen, and randomness can affect things. And most of the time, price is random, but that doesn't mean that price does not follow the returns, even when price is random. Price does, in fact, follow the returns most of the time, even when price is random. So, as to the question of whether or not the assets are going to go up, down, or sideways, the answer is yes. They will go up, down, and sideways. Right? There's not some miraculous 20 questions quiz game that we don't know the answer to. We know the assets are going to go up, down, and sideways. That's all they ever do. We know that because look at the charts. And specifically, the way they go up, down, and sideways is the assets move like this. Returns will distribute away from the mean of returns. Right? So the returns themselves, the amount of returns on investment you're getting, will distribute away from the average or the mean of the returns on investments. Once it's done distributing away, or moving away, if you want to call it that in simpler terms, once they're done distributing away from the mean of returns, then they will eventually revert to the mean of returns. That's just a fact. That's what's happening. That is what's happening. And until you understand what that means, right, that price action distributes away from the mean of returns, and then occasionally, not occasionally, whenever it's done distributing away from the mean of returns, that it mean reverts to the mean of returns. Once you understand that, then you understand something about you understand something about how the assets move, and what they typically do. Hello, everybody said hi. I say hi to everybody saying hi. You all are nice. Okay. Good to see everybody saying hi. Hey, folks, good to see you. So that's all the assets do, right? They just move away and move to the mean of returns. And the price action just follows those returns, which is why if you look at price action on like low time frames, you'll see what does it look like? It looks like it's zigzagging a lot, right? Why does it look like it's zigzagging all the time? Because it's zigzagging all the time. What is zigzagging around? It's zigzagging around the mean of returns. Why do you think on our alpha trading tools, one of the most important tools that we have are the power means? Because the power means show you very clearly when the assets are distributing away from the means, which are represented by the power means, right? The means of returns, or when they're distributing, or when they're mean reverting to the mean of returns. You can see clearly. Why do you think the RMLR is so important? Because not only can you see when it's distributing away, you can see when the distribution is kind of maxing out, and you can see when it has begun to actually mean revert, and you can see the target of the mean reversion, which is the RMLR itself, and you can see the future direction of the RMLR with extreme precision. So we know which direction the RMLR is going to. So we know which way the asset is likely to move in order to complete that mean reversion. But of course, it can take all kinds of crazy ways. It can mean revert up, down, or sideways, and it frequently does do something that may seem like illogical, but it actually is very logical. When you see it complete the mean reversion, you're like, I understand that, right? That's why these tools are very important in our tool set. Now, you don't necessarily need to use our tools. You can, gamble. A lot of people do. In fact, most people do. They try to use other tools until they realize they're just gambling with those tools. But the tools we have, they're it's to remove as much of the element of carefree risk taking or gambling as possible. Right? It's to make the trading less of a gamble. Because you can always argue, well, technically speaking, because there's randomness, it's a gamble. Yeah, okay. Crossing the street is also a gamble in that same sense. Right? You have all the calculators from your brain to tell you when it's safe or not safe to cross the street. But there's still the random chance that something terrible could happen without you knowing it, even if it seems like absolutely nothing bad could happen in this given context. Then all of a sudden, some random thing happens that you weren't expecting, and it's over. Right? Anyway, that's going to do it for now, folks. I'll talk to you later. Happy Sunday. Hope you're doing well, whatever you're doing. Stay safe. And cheers.